Howdy. Welcome back to Dion Talk. This is going to be a live stream that goes on, I want to say between 1 and 3 hours. I want to try to answer every question that comes in. And in the beginning, I'm going to talk for 10 to 15 minutes covering a subject, giving you a chance to get your questions into the comments. I might have a guest or two stop in to the live stream. But the purpose of the starting content on this video is a very sneaky article that Redfin put out. And Michael Zuber's actually commented on this video, I think in 2 different videos that came out this week. He commented on this article in 2 different videos that came out. The article starts with very crash sounding information because even Redfin has figured out that to get eyes on articles or eyes on videos, it takes scare tactics. So the article came out earlier this week, and maybe at the end of last week, and it talked about numbers going down. And the beginning of the article mostly focuses on 15% less new listings. So we've had a decrease in new listings being put up because sellers are in panic mode, because buyers are backing out. It's almost like the Fed is trying to curb inflation by raising interest rates, trying to slow down the economy, which should make less transactions happen. So in the Three Amigos with Michael Zuber from One Rental at a Time and Matt the Lumberjack Landlord, we've often talked about a crash in transactions, and a lot of people constantly say a crash in transactions means less demand, which has to mean a crash in prices. Higher interest rates means people's buying power goes down, so that has to mean a crash in prices. We would love for a crash in prices to happen. There isn't an investor who's investing for cash flow that wouldn't like to find deals that cost less money to get into for a better return. So sometimes we see comments about people saying, well, these guys are just talking up an asset class that they've invested in, thinking that we care about net worth, which is actually a number I wouldn't know unless I did a video on it, because it doesn't matter. It's almost completely fictitious. So when I see things like the median asking price for properties is down 5%, sales prices have gone down. Sale prices, like the cost it actually sold at, is down 6%. Fewer people searched in Google for homes for sale. Mortgage purchased applications are down 21%. This is how this article starts. A bunch of big, scary numbers that looks like everything's trending down. Well, if we look at that, the beginning part of the article is mostly talking about month on month, or in one case, week on week information. Now imagine this. End of summer, kids are back to school. People are moving less because school year has started. So transactions should go down because they pretty much have gone down either in July or August every year for the last 10 years. There have been a couple where it spiked oddly because of interest rate changes or something, but for the most part, month-on-month data dips this time of year almost every single year. It isn't until at the end of the article, and this is why I call it sneaky. It's not that Redfin's getting out the wrong information. It's they knew they put out the information at the beginning of the article that would get the most attention. Scary. End of the world. It's, don't take action. Have an excuse to sit back and think, I'm going to wait 6 months and then jump in when things are better. Well, what's going to improve in 6 months? Do you think all of the demand and all the people that are sitting on the sidelines because of articles like this are going to sit back in 6 months and think, prices are coming down, I'm going to wait to buy until they come down a lot? No, they're going to think, as soon as it comes down enough for me to get the yield I'm looking for, demand is going to be back. Or let's say interest rates go up so much that enough buying power goes away to where prices would come down, which is not what happened the last time interest rates doubled. Home prices almost tripled. That was in the 1970s. Magically, though, let's just say interest rates go up, home prices come down. Well, now you're paying more money to the lender instead of to the seller. It's still costing you more. And some people say, well, it's better to buy a house low so that I can refinance to a better rate in the future. No one has the actual functioning, working crystal ball to know that in 5 or 10, 15 years, interest rates might ever be below 5% again. Everyone's guessing. That's just, in my opinion, just as bad as gambling on appreciation. If you're going to gamble on appreciation, you're gambling on interest rates coming down so that eventually, hopefully, it makes sense to refinance to a better rate. You watch interest rates after you close on a deal so that you know if this is the time you want to refinance or not. But I wouldn't invest thinking this will be a great deal if rates come down so I can refinance. So we have all of these big, scary numbers. And for over 6 months, the three amigos have consistently been talking about a crash in transactions. There was actually a period of time where that's all we called it, was crash in transactions. And I realized we were shooting ourselves in the foot because there's all these channels that talk about a real estate crash and they get more views. So if we call it a real estate crash, which a crash in transactions is, we get more views. You can look at my channel. There are times where I talk about there's no housing crash coming, I get 1,000 views. If I talk about the 2022 housing crash, I get 5,000 views. And then in the video, I clarified that is a crash in transactions. Stephan is great. He did a video last week on the massive housing crash that's going on, got a ton of views. Second half of the video was all a bunch of data, like at the end of this Redfin article, pointing out all of the reasons why we're not going to have a crash in prices. So at the end of this Redfin article, month on month, some data is down. I understand, totally fine. Applications might be down because year on year, interest rates are twice what they were a year ago. Totally makes sense. Applications would be down. In a crash in transactions, when less deals are happening, I would expect to see less mortgage applications happening. And Redfin was good. They actually called this new purchase applications because it's really easy to say there's a massive crash in mortgage applications for refinances, because does it make sense to pull money out of a deal or to refinance to a higher interest rate than we had for the last 2 years? Of course not. So those are down somewhere between like 70 to 1,000%. People are saying, I'm not going to do that. But on new home purchases, a crash in transactions correlates to a lower amount of new purchase mortgages. But let's look at year over year. A month ago compared to a year and a month ago. Home prices are 6% higher. Does that sound like a crash? Does that sound like people that could have purchased last year, waited till now, said, I'm going to wait for a year, I'm going to wait for 6 months or a year for that crash or correction to happen, that are now missing out on a year's worth of principal paydown, a 6% increase year over year? Yes, it sounds terrible when we just had a 15, 20, and in some markets like Seattle and San Diego, 30% appreciation. 6% sounds small. There were 2 places out of 400 markets, almost like 390 markets, but almost 400 markets. There were 2 where the prices are actually lower now than they were last year. The Bay, and I'm not sure how they call this 2 areas, the Bay Area and San Francisco. Is that not the same place? I don't know. I went to school in America. They don't teach us this stuff. The median asking price is still up 10% year over year. Pendings are down 17%. This lines up with crash in transactions means less deals happening. Like the whole point of a crash in transactions is there's less transactions happening. So pendings being down 17%. New listings are down 15%. Less deals are closing. Less deals are pending. Less people are wanting to try to sell their property because 2 months ago, people were in shock on the seller side. They had a couple of years where you can list a property, pretty much put your wish list price out there and come really close to it or go way above it. And then interest rates changed, impacting people's buying power. The all cash over asking waiving contingencies offers didn't come in as quick. And days on market, which in a lot of markets, 60 days on market is healthy. We have a record low of 17 days on market. In the last year, it was around 21 days on market. It has increased so much. It's up to 25 days on market is the average. This is information that comes out at the end of the Redfin article. Sale prices are still up 6%. Pendings are down. New listings are down. 36% were under contract within 2 weeks. So it's not that all of them are waiting 25 days. It's the average days on market. So you have some where people put a stupid price, don't need to sell, aren't motivated sellers, and they just leave it on there hoping eventually somebody will make an offer that makes sense to sell it. There's no reason to pull it off. It's not like it costs money to have it on the MLS. Days on market up to 25. That's barely an average of where Michael Zuber is looking for his rentals. for the last 2 years, speed was your friend. The faster you got an offer in, the less chance there was for that seller to realize they were about to get inundated with a ton of offers, waiving contingencies and being over. So you wanted to be in fast. Now, time is your friend. I've increased my search to where I don't look at anything that hasn't been on the market for 10 days. I'm not as stretched out as Zuber with his 30 days. He started with 15. He did a Business Insider article where he changed his days on market search to 15 days on market. He's now at 30. Looking for the great deal, not just a good deal. But here's the two numbers that came out at the end of the article that I really like during this massive housing crash that we're seeing. 38% of transactions that closed in the last month were over the asking price. That sounds like a massive crash to me. 7.7% had a price reduction. That doesn't mean that their value went down. It means that they listed it too high, meaning 92.3% didn't. 38% went above that. 7.7 had a price reduction percent across the board. I'm hoping this makes sense, that the article gets attention because it sounds bad. If we said things like an average growth is 3 to 5% in real estate historically for the last 100 years, and this year we've seen a 6% increase, nobody would look at it. But if we say there's a massive crash, 15% of new listings drop, median asking price is down 5%, sales price dropped 6%, not clarifying right off the bat that that's month-on-month data that almost always comes down at this time of year, every year. And then following up at the very end of the article, which I actually do give Redfin credit for, because they put out the data that says, looks like a kind of a healthy market. Days on market is 25. It's not even close to the 60 that would be an average, consistently, a healthy market. It is up 4 from 21, which is only up 4 from the record low of 17 that we've seen. But 38% of homes that were listed, and some of them probably at wish list price, still went for over asking. So before I get to the questions, and I'm hoping that there's questions tonight, and maybe one or two of my guests will stop in, I want to talk about it's okay to watch multiple sources of content. You should take in content from people who have invested with different strategies. I watch Investment Joy. He invests in laundromats and has some, a bunch of great content, invests in ways that I wouldn't, but I learned from a lot of his videos. Michael Zuber and Matt the Lumberjack Landlord have invested in ways that are very different than me. I don't want a large rental portfolio. I was looking for multiples of enough cash flow to make it possible for me to never have to work again in my life, with confidence that I can handle something as much as a 50% rent reduction across the board and still not have to work, even though we've never seen a rent reduction across the board. I've diversified my portfolio, the property types, the property locations, the types of tenants. That was my goal. But I still learn from Matt the Lumberjack Landlord. He has his product reviews. I learned from that. Michael Zuber, who has both of them have invested throughout times like the housing crash of 2008. So a lot of their strategies I've used to incorporate in my investing so that I'm confident that I can handle another housing crash. Like all investors, I still hope for a housing crash. It seems kind of mean to hope for a crash because that means that some people are losing their house, because the thing that causes a housing crash is a massive wave of sales, forced sellers coming on. And we don't see any reason for that. Let's say every house that was for sale went up 100%. And instead of the average house being around 400,000 or whatever it is, and it was 800,000. Would that force anybody who owned their house currently to sell it? It might encourage a few to. That increased supply might lower the price. As investors, we would love to see prices come down. But I know with confidence, they're not going to. And the longer you wait to buy, the more it's going to cost you. There are some people who are in a specific situation, they themselves, based on their income, the security of their income, what's trending. If you're in a field that could go, like right now, if you're a real estate agent or a lender and there's a crash in transactions and your income can be significantly hit, maybe that's the person that might want to think about their investing a little differently than a person who has a stable job. And when people talk about a recession, one of the things that comes up often is people say, I wouldn't want to own a rental property. There's a recession and somebody might not pay their rent. If you don't have rental properties, I'm guessing your source of income is your job. And if your concern is that a recession is going to cause layoffs, isn't your job a little bit more, concerning than having a rental, especially if it's small multifamily where you have a diversified tenant base, some people in the military, some people on Section 8, some people working or retired. Retired people aren't impacted by layoffs. Military people aren't impacted by a stock market crash that can impact the retired folks. The Section 8 program can be impacted by a government shutdown if it was long enough. We've seen one in 68 days that didn't stop Section 8 payments from being made, but it's possible that it goes on long enough. So that diversification of tenant base makes me sit back and go, the person I'm concerned for is the one who just has a job, that isn't thinking, how do I get multiple streams of income? And so many people have heard of that. The average millionaire has 7 streams of income. That might be 7 different types, but each rental is its own job. Can you imagine getting fired from all of your jobs at once? You would have to have bases shut down, the Section 8 program stop paying, a stock market crash. And if all of these things happen to where all of these different types of tenants don't pay, we have more to worry about than that. Look what happened when they have a pandemic. We shut the world down. You can't go to work. You don't have to pay your mortgage. If your tenants decide not to pay the rent, initially it wasn't ran very well, but $46 billion was set aside in the CARES Act for rent relief. And when it was initially set up, tenants had to go in and ask for that money to be paid out. So the tenants who are unethical, who were continuing to work and just decided to not pay rent, some landlords got in a little bit of a bind if they didn't keep good reserves and have a well-diversified portfolio. The CARES Act was amended later to where the owner of the property, who did not have to pay the mortgage, the principal and interest, could go and say, I'm not collecting rent, and get rent relief. Throughout all of 2020 and 2021, I've never seen or had one late or missing rent payment. And Michael Zuber has had, I think, 2 tenants messing with him. Matt, the lumberjack landlord, had 2 or 3. Both of them have over 100 units. So that's a 1 or 2% impact to the portfolio. It's always a good day to buy a great deal. And the content on this channel and the guys that I work with and girls that I work with is to help you get into this kind of position to where if a recession happens, you can benefit from it. I see that Brian left some messages. I'm going to read them all. Howdy, Brian. I appreciate that. And thank you for the super chat. Let me know in the comments. I'm actually thinking of doing this thing where I give away an audiobook. I'm trying to think of how to do it. And the idea is, it's not so much about the money from the super chats, because I'm going to kind of try to break even on this. It's that super chats let YouTube know people actually like your content enough to put money into it, not just likes and comments, which are amazing. But so let me know if this is fair. Every super chat that comes in that is at least 99 cents, I will use the Dice of Doom, which I will have to go get. I should have planned ahead. And decide who gets a free audiobook, which I will send to your email. So you'd have to connect me with email. And I'm hoping it would be a finance related book. Rich Dad, Poor Dad, One Rental at a Time, 15 Conversations with Real Estate Millionaires is coming out soon. Zuber has it all uploaded finally. And now we're waiting for, not Audible, there's some other company to finalize it. But it doesn't have to be. It can be a fantasy book. It can be whatever. Brian, let me see. Howdy. I'm still trying to figure out Matt's potential deal to help out a financially distressed retired couple. I don't understand how he can make a profit without causing their housing expense to increase. If he leases their property back to them, wouldn't their rent be greater than their current mortgage? Maybe him sharing some hypothetical numbers would help me understand, or maybe I'm too lazy. I sure hope it works because I would love to replicate it and help people stay in their home. That would be awesome. So there's a chance Matt might jump in, not sure. If not, his live streams are Sunday morning, 8:30 a.m. Pacific, and you can ask the question there. I'll actually send him a screenshot if he doesn't pop in tonight. But there's a lot of times where buying a house from somebody who's financially distressed can actually help them stay in it. If somebody has fallen behind on their mortgage and is having trouble catching up and is looking at a foreclosure or a strategic, there's something that Michael Zuber calls it. It's like a planned foreclosure. You can purchase it. They don't have to pay that money right away because the sale of the property recoups the losses to the lender. They could stay in their house. And rent isn't always above mortgage. You don't know what interest rate they were at. And sometimes the mortgage expense is not what's keeping somebody from being in the house. It could be maybe Matt needs to put a new roof on, replace the water heater, fix the foundation issue, whatever large issue or expense that person might not be able to do because they're already struggling with just the mortgage payment. That's why a lot of people stay renters. They don't want to own. They don't want the expenses and hassle of maintenance and upkeep of a property. There are a lot of situations where you can buy a house, especially if it's a retired couple like this. It's hard to go to Section 8 and say, look, hey, can you guys pay my mortgage family? But if you're on fixed income and you're losing your house and you sell it and now you're renters, you can get on the program. And Matt is doing about a third of his properties in the Section 8 program, which he might change. He's having some issues with his local Section 8 housing authority, and which that is very local. I invest in 2 counties. There is one county which I usually I don't like to name things, but Pierce County, Washington sucks. I will not own a housing Section 8 property in Pierce County. Thurston County, Washington, it's amazing. It's a great program to work with. The people are responsive and they work with you. So it depends on your local area, whether that's a good thing or not. But there's a couple times where it makes sense for somebody, and Matt probably has more details on this specific deal. So like I said, if he comes in tonight, I'll pop up to the top here and read this. If not, Sunday mornings, 8:30 Pacific. Laura, howdy. Dividend Dave, howdy. Hoping to see you at least one more time at our next real estate meetup here. Dawn, howdy. Happy Tuesday evening. Dion Group, it is Tuesday. This live stream reminds me of what day of the week it is. I haven't been retired long enough to lose complete track, but I'm going to work on that. Rich, howdy. Here we go. Matt, howdy. Matt Bittner, how do you think housing is going to weather millions of layoffs and higher interest rates? So what makes you think millions of layoffs? That would be my first question. What fields are crashing that much? Almost everywhere I see still has help wanted signs. I ran a nonprofit. To transportation placement services. We still have employers reaching out every day that can't find people. People might end up changing jobs. There's remote work that's available. I don't want to say I hope. I think an impact to a lot of layoffs might be an increased demand for rentals, which is unfortunate for people looking for a place to rent. You might not get to live in the area that you want to because remote work is making it easier for people. Here's an example. King County, Washington, and Seattle had a lot of the companies around there. So you got Microsoft and Boeing and Costco's headquarters and like all of these things around Seattle where you've got to live there to do that. Well, now they have remote work options. So Pierce County and Thurston County rents almost doubled in 2 years. That's going to happen more and more. Like that's more of an option now. For the first year, people would rent because they weren't sure if their employer was going to require that they come back to work or not. They could actually just rent a place, some month to monthly, some 6 month or 1 year leases, and then find out what their company was going to do. But a lot of that has stabilized now. There are companies like Tesla that said, come back to the office or we're going to let you go. There are companies like Pinterest that paid $89 million to break their lease in San Francisco and paid $20,000 to employees to relocate. No plans to go back to the office. Who knows what they're going to do next month, but that seems like the way they've chosen to go. Now those people can buy. Increased demand on purchasing means price increases. There could be less transactions because a lot of people lost buying power. But if you were in King County in Seattle or in the Washington area, making $200,000 or $300,000 a year, and you move to a place like Thurston County where the average income is less than $50,000 a year, that's a huge change. Still a lot of room for prices to go up. I would be interested to think of the millions of layoffs that when everybody is trying to high and unemployment is less than 4%. So a double in unemployment puts us to 8. And remember, it wasn't unemployment that caused the 2008 housing crash. It was bad loan products. We had over 50% adjustable rate mortgages in 2007. We're at 11% now, which is more than it was a little over a year ago. It was 3%. So they have increased because I think some lenders are predatory and some people get talked into things. But there are people like Matt, the lumberjack landlord, who has a large portfolio and an adjustable rate mortgage on 1 or 2 of the properties because he has the cash flow to handle the risk. But if you're buying your first, second, or third rental or your primary house and using an adjustable rate mortgage right now, and you're living on hopium, hoping that you're not laid off in 3 years, you can refinance in 3 years, and rates aren't 10% in 3 years, that's not a position I'd want to be caught in. So I'm trying to game theory it though, Matt, not saying, because I'm not the crystal ball guy. It's not, I see a housing crash. I don't see a housing crash. I don't think people should buy now. I don't think people should wait. I think you should hunt for the great deal and buy it when you find it. So if that's tomorrow, you pounce on it. If it's next year, you pounce on it then. You hunt until you find it. If there are no layoffs, have a plan. If there's a ton of layoffs, if you own the rental properties, let's just say game theory, there's massive layoffs, a bunch of people lose their houses, creating a flood of inventory, and prices drop. The people losing their houses become renters, increasing demand for rentals. So if you own properties now or you buy properties in the next few months, you'll be the person who will benefit from that massive crash in housing prices. And people will say, well, yeah, but you could have waited and bought it for less, right? You could have waited and bought it for less, but it would have had to have been significantly less so that it makes up for cash flow between now and then, seasoning the ownership of that property to make it possible for you to have rental income on your tax returns so your debt to income ratio doesn't matter for the next purchase. Like all of the benefits of getting in now. So that's one thing that a lot of channels do. They get more views. They make a scary prediction. Here's the crash. Here's the reason why you should sell all your crypto, sell all your stocks. I mean, watch something like Richard Fain. Every 3 or 4 days, it's I'm quitting, it's a scam. This is a ripoff, right? It gets a lot of views. Instead of that, my content is, if interest rates go down to 1%, here's what I would do. If interest rates go up to 10%, here's what I would do. Instead of, here's what I think is going to happen, so this is what I think you should be doing today. It's, if these things happen, here are the strategies that make that not matter. Hope that helps. Trucking landlord, howdy. From Chicago, nice. I believe that is close to where Millennial Mike is investing now. Chester Williams, howdy. Investment joy is decent with the laundromats, yep. One big cash cow for those would be hospitals and universities. Very true. Rob, howdy. So tired of being retired yet? Somebody asked me the other day if I was bored yet. I've never actually been bored. So I'm not sure that that's possible. I did put a social media post up this morning because I constantly get this question from people saying, if you're not working, where will you find your purpose now? And some of them might think it because I was the president of a company. I was the president of a company that I started off as an entry-level position and was demoted all the way down to president. I grew the company. I had ideas that affected legislation, that affected hundreds of employers, thousands of graduates. And a lot of people identified me as the transportation guy in Washington State. If something came up with any kind of legislation that was coming out, any kind of higher education thing that was changing, I was who they would talk to. How sad would it be if I got my identity from a job? If your purpose is from your work, this is just my thoughts. In order for it to be a job, for it to be work, one of the requirements is you are compensated. Is anything your purpose if you have to be paid to do it? You can get paid to do something you love. So if you have your purpose and you then monetize it, sure. But if it's a job, it's still a job. Yeah, I've never found identity in my drive. Drove a truck for 17 years, never really called myself a truck driver. Yeah. Chester, good evening. Chester to Rob. An interesting aside, I've noticed that Zuber has exchanged one 9-to-5 for another, from sales to helping people reach financial freedom, one rental at a time, something he loves to do that he then monetized. I think what happens after retirement question depends on your purpose for wanting to reach retirement. Very true. My chat moved, which I appreciate. And I lost where I was at. 15 conversations with real estate millionaires is on its way. It is, as soon as that company gets it sorted out. It's all recorded. It's been in Zuber's side of the court for a couple weeks, and we'll see what the timeline looks like now. Mr. Sethmo, howdy. Do you use your binder strategy only when purchasing a new property with a tenant in place, or is it also applicable when raising rents on tenants living in your current rental properties? That is a great question. Originally, the strategy developed because I was buying properties with existing tenants in place. So on a couple of videos on my channel, I teach how to use the binder strategy. So it's an actual 3-ring binder. It gets the tenants to request a rent increase. This is actually a version of one that I just did a few months ago. Normally, what I would do is acquire the property. I would wait about 2 months because I didn't get to screen or vet these tenants. I don't know their credit scores. I don't know their work history. I don't know anything about them. But for those 2 months, I get to find out the 3 things that do matter. I don't really care what their credit score is. I don't really care about their work. I don't care about anything. But there's 3 things that we look at: credit score, eviction history, and work stuff to find out if we think this is going to happen. So I get a 2-month period to figure out, based on experience, if this is going to happen. Do they pay their rent on time? Do they call me for super trivial things? Do I get noise complaints? If those 3 things happened in those 2 months, I might not want to renew the lease with that person and not do the binder strategy. I haven't had that experience. At the 2-month point, I would use the binder strategy and get the tenants to ask me to increase their rent. That was normally how it worked. And then every 2 years, so not every year, but every other year, I would do a 5% rent increase. I would tell the tenants this at the end of the binder strategy. I would say, hey, look, hey, unless there's any big changes, my plan is next year, the rent's not going to change. At the 2-year mark, we're going to look at about a 5% increase. That worked for 6 or 7 years. I was able to keep up kind of close to area average rents without having to do a lot of rehabs. I don't have to displace tenants. There's a lot of benefits to the binder. Tenants are happy. And then 2020 happened. For a year, we couldn't raise rent. So there were a couple of my units that would have been the 2nd year on their lease, would have been a 5% increase. But we had the eviction moratorium, rent freeze, uncertainty, and a bad time to raise rents, in my opinion anyways, to keep tenants happy. So in 2021, I watched area average rents, and they went up so much in my area that I then did the binder strategy with every single tenant. The duplex I acquired in 2021 and all of my existing tenants. On average, I saw a 20 to 28% rent increase across the board at tenant's request. Still have happy tenants. I had one tenant purchase a property, helped him find an agent, helped him talk to lenders. I had another tenant that moved out of the area. So I've had 2 tenant turnovers in 2022, doubling the number that I've ever had in the last 10 years. In 10 years, I've had 4, including these 2. And I actually did a video recently on the slides talking about when tenant turnover is a good thing. I saw 20 to 28% rent increase using the binder strategy on existing tenants. This is the first year that I've done that. The tenant turnovers, I guess I did a rehab. I had to spend the money, replace flooring, do paint, swap out electrical. Some of the things like the electrical, super cheap, but the paint and the flooring, if I did it myself, probably could have saved some money. But as I mentioned, I'm lazy. The whole purpose of my investing is not to create another job. I provided work for handymen to go do the stuff like paint and flooring. Rent increase on one, To do the math. %60 rent increase. That's not bad. That's like 55% rent increase on one. And the other one was about a 40. That's how much rent's increased. So sometimes it's better to have a tenant turnover. Those two, the tenant was buying a house, which I try to talk all my tenants into buying. I want to help them get on the property ladder. I don't want to relocate a tenant, displace a tenant, cause this problem in their life, right? I want to help the tenants, but when they're going to move, you can benefit from having to do a rehab, having to then research your area market rents and getting top dollar. Rhinophiliac, howdy. Is that somebody who's afraid of nose jobs? No. I think you should do a video of analyzing actual deals on the market. I haven't seen a good deal in a long time, and I look all the time. Okay. That is a good deal. That's a good idea. I should do that. Maybe I could do that with Three Amigos, where we actually look at deals we're being sent and talk about whether they're good or bad, or what we've determined to make it good or bad. That's a great topic for a video. So, howdy, Rhino. Howdy, Ryan. Jay Hayes, cheers, howdy. Strategic default, thank you. Yes, that was when people do that. Chester, I offered another ridiculously discount on a property, 3.5, that went on at $455. I offered $365. Nearly a shade under 20% off their list wish pricing. Right, exactly. Let us know how that goes. Dawn and Bev Perkins, howdy. Layoffs won't matter until the jolts start dropping. There's some mismatch, but most places are still having trouble finding people. Yeah, most places. So I'm the truck driving school I just left. We have 3 or 4 positions open for non-CDL stuff. And it used to be 30 applicants for a position. Now it's maybe 3. And most of those are people who are working unemployment, trying to stretch out their time on unemployment. And then the same with the nonprofit. Companies can't find people. Nice. Don and Bev asked Chester if you got a response. Yes, lenders haven't gotten aggressive enough yet to cause the crash. Good point. I wonder what part of the economy might break that we aren't seeing and could cause a correction. That's kind of the thing, is you're always wondering what you don't see. And for me, that's one of the reasons while you're in growth phase with your rentals, I would go up to 70% loan to value, but I wouldn't go above. And in retirement phase, like I am, I want to be around 50% loan to value, but I wouldn't go above. And I don't want to go too far below. I still want to be gaining appreciation on multiples of what I've invested, seeing principal pay down, having all the tax benefits. So that's the first thing. And then diversifying, so you don't have, like, I wouldn't want all of my tenants to be military. If you're right outside a military base, find some contractors. Find some people who work for the local school that the military people attend. Find some non-military in case that there's a BRAC meeting, that base closes. That's going to greatly impact that. That's one of the main reasons why I wouldn't want to own a 10-unit apartment complex for the first 10 years. I want duplexes, triplexes, or fourplexes that are at least 10 miles away from the others, so that I'm pulling tenants from multiple sources. So if something like there's an aerospace crash and Boeing goes away, it's not really going to shut Amazon down. It's not going to close the port here. It is going to impact somebody. I think I have one tenant who worked at Boeing. One. Right. Diversify tenant type and property locations. So you're gamifying it. You're not saying, I think this will cause the crash, so I'm adjusting how I invest. I'm investing in such a way to where if a crash or correction happens, let's say prices of properties drop 50%. That's a lot of people losing houses, becoming renters. I would benefit from that. If prices continue to go up and it's harder to find deals that cash flow, owning rental properties, let's say they just kept going up forever. Magically, hypothetically, there is no crash or correction in our lifetimes. Every year that you don't buy means it's going to cost you more to buy. Chester, to Don and Bev, I got an offer decline, but I'm going to keep at it. Houses are simply listed way too high. Nice. So my son is buying in LA, and I'm very sorry. And I'm going to try to convince him to be more aggressive and bid lower. Good. I like it. He has a really good salary and not sure he'll want to spend the effort, time, but the agent will. A lot of people think that an area is high cost of living, so it's not worth investing in. My problem right now with LA County is the eviction moratorium that was, federally determined to be unconstitutional. It's still in place in LA, so there's some kind of dictatorship thing going on there. It's the same thing in Washington. I wouldn't own in Seattle. Like if you gave me a property, I would sell it. I would not own in that area. So it's not that some places are tenant friendly or landlord friendly. It's that some are anti-business, period. They just don't want private business. But if he was going to invest in LA, my brother invests in Southern California in a town called Rosemont, right outside of LA County. Prices and rents line up to where he's actually able to get profitable deals there. The comparison, and I would do this with Millennial Mike at some point. He house hacks in an expensive area. So house hacking becomes more important. So if your son is investing in LA, I would suggest house hacking. The more expensive the area, the more impactful it can be. Like I was talking with Breck Bassinger, who is the star of Stargirl, and she did a video on my channel. She house hacks, and in order to be able to pick and choose the roles so that she doesn't just have to take a job, she can take the job that was the best role for her. She eliminated her largest housing, her expense, which was housing. So in LA, house hacking is very important, like Millennial Mike house hacking in Seattle. Then this is where we diverge. Mike invests at a distance and averages $250 per door. Whereas if he repeated the house hack in Seattle, he would then profit $2,400 on the property that he's moving out of and being able to reproduce the house hack in another unit. How many properties at $250 a month does it take to get the income of one rinsed and repeated house hack in the expensive area? Less tenants to manage. And he's in a duplex if he moves out, and that starts to cash flow $2,400. He has 2 water heaters to replace. A friend of mine pointed this out recently. If he had 9 properties to get the 250 up to the 2,400 that he's going to make, however close the math is get on that's 9 water heaters, 9 roofs, 9 foundations, however many doors in each unit. Sometimes it's not about unit count. It seems like it's in a lower barrier of entry to invest in Gary, Indiana, or Chicago, or the outskirts of Chicago where he does, than it is to invest in a high cost of living area like Pierce or Thurston County in Washington. But what is your goal? My goal was financial freedom with the least number of units that I needed. I have 16. I'm not even sure I want that money. I might sell 1 or 2, take the money, pay off some of the debt, increase the cash flow, reduce the number of things I have to take care of. There is no one right way to invest in real estate, but there is a one right way for you. And then Matt Bittner, like me, thank you, Matt, for asking this. What are jolts? Howdy, Matt. Howdy, Joey. Are you noticing more buyers getting seller credits in contracts? Seller credits, sellers paying closing costs, stronger negotiating, because when you have multiple offers above asking and you go and you're under contract and you say, look, I like it, but in my inspection, I found this and I can't buy it unless you fix that. If they have 10 other offers, the seller is not obligated to close with you. Some might if they're in the middle of a 1031 or something, but they don't have to. And the more offers there are, the less negotiation power the buyer has. So we're not quite in a buyer's market yet where sellers are paying all closing costs and conceding to everything and dropping prices and that kind of stuff. But we're seeing more towards the balance side. Days on market ticked up from 21 to 25. 60's healthy. So we're closer to the pendulum being in the middle, but we're not so far over to the seller side as we were for the last 2 years. Don and Bev Perkins, job openings from the Job Openings and Labor Turnover Survey. I think that's the whole thing is job openings, but that's really just a part of the report. I think that comes out Friday, or not. So the jobs report does come out Friday. All I know is the last one, people were expecting 200 and something thousand, and it was twice that. So 100% over what people expected. Sounds like a healthy market to me. Don and Bev, there is still like 1.5 to 2 times the number of jobs for every unemployed person. That needs to get much closer to the one to one for us to not have continued wage pressure. It's kind of funny. Most people don't understand that right now the federal government is saying this to corporate America. So imagine this: you vote people into office for your best interest, and the federal recommendation to corporate America is stop giving wage increases and lay people off to help the economy. Have you thought about that? Joey, what have been the most expensive repairs you've had to make for your properties? Good question. So there are different forms of investing. Matt, the lumberjack landlord, buys, he wants to buy C properties in a B area and then upgrade them to a B property and get the best rents. So he does a lot of upgrades, kitchen rehabs, bathrooms, those kind of things. I prefer to buy rent-ready, already occupied properties. I'll take a rent-ready empty property. I have a couple of those. But I prefer to have tenants in place already. The binder strategy helps. Knowing that I'm going to get my tenants to ask me to raise the rent makes it a lot easier to find cash flowing properties on the MLS. So I haven't done a kitchen rehab. I haven't replaced a shower. I haven't, even no matter how many movies or HGTV shows you watch, I've never taken out a wall and changed structural integrity of a building to give them more open anything. I was not investing to create a job. I've never done a burr. I've never done a flip. I buy rent-ready or already occupied properties. The biggest expense I think I had knowing it going into it was I was buying the fourplex and it needed a roof. My single family house needed a roof 2 years before that. So I've done 2 roofs. What was it, like 8,000 and 15,000, something like that. But the fourplex is, 4 units, 4 garages, massive scale or number of squares, tiles, whatever they call them, that roof was going to be done. So it was a lot more than the single family. The single family was like 8,000 because it's like a 13 pitch. It's a A-frame house. Other big expenses. Haven't had any foundation issues. I replaced a water heater. That ends up, you can buy them for around 800 to 1,000 and a couple $100 to have them put in. I replaced garage doors for $2,000. 3 years ago, replaced a garage door for like $1,200. And then last year, end of last year, beginning of this year, replaced one for $2,000. So inflation sucks. But expenses like that do not impact cash flow. When I was looking at the fourplex to figure out my cash on cash return, I thought, here's the down payment, here's the closing costs, here's the money for immediate repairs. I factored in, when I was running the calculations initially, a $20,000 estimate to put a roof on a fourplex. I had estimates up to $30,000, and then the one with Clearview Exteriors out of Yelm, Washington, who has great service and great prices, doesn't sponsor me, but did great work, gave me a good price. He's done both of my roofs. The cash on cash return was still better than 10%, even with the expense of putting the roof on. So it's not that expenses that need to be done are a deal breaker. Like if I found a place and there was foundation issues and a lot of people would back away, that means less competition. I would have an actual foundation company go in, do an inspection, give me an estimate. I would pad that a little and I would add that to my cost to acquire. If the deal still made sense, I would pursue it. And my investing strategy, I think going forward, is going to be the same. Even though I was a single parent with 3 kids, working full time, investing in such a way where I didn't want to do rehabs. So I was buying the rent ready or already occupied properties. I probably could increase the yield a little bit if I bought properties that needed sweat equity and I had contractors do work after I acquired them. But I didn't retire to increase my time at investing. I retired for time freedom. And while I do enjoy looking at deals, it's like a hobby, kind of like, some people buy lottery scratch tickets. I like to see the emails come in from my agents for my auto searches so I can open up each one and think, is this the next property that's going to increase my cash flow? But I'm not looking to buy projects. Jay Hayes, Chicago in general is anti-business, a tough market, not undoable, but tough. Seattle, I'm sure there are people who invest successfully in Seattle. I'm a member of the Seattle Investors Club. They have a mastermind that meets every Thursday. It's free. It's at 11:30. Just go to seattleinvestorsclub.com to get in there. People from all over the country are in there. It's got a branding issue with the name saying Seattle Investors Club. But there are people in there that do invest in Seattle and do just fine. I'm probably more successful than I am. It's just not something I want to do. And Don and Bev Perkins took back a message to make me wonder forever and ever what it was. I'm gonna lose sleep tonight. Don and Bev, it's primary in his case, but good point on moratorium because rental is the fallback if job market makes him move. Yep. He has rental roommates. There you go. He's been pushing for same in the purchasing decision. I haven't seen his LE yet, but he said 30-year fixed rate 4. Okay. I said make sure he reviews the costs. It doesn't have huge points on loan origination fee, right? So one of the things I like to do, Don and Bev, is anytime I'm under contract and I have a loan, take that loan offer in writing to other lenders. They will be the first ones to point out anything like a fee that's too high or how the points work. They might not be able to beat the rate. They might be able to match the rate, but cut the point buy down in half and compare it live. I've got a couple of videos on this channel on how to get the best rates. And it's just like any contractor. Most home buyers, especially if your son's buying his first primary, it's you find a lender and you feel this sunk cost theory. I've worked with them. They've been super nice. They've answered my emails. They're a contractor. If somebody's going to have a deck put on, they're probably going to talk to 3 contractors and get quotes and look at which ones have the best reviews, which ones give the best warranty, which ones labor, materials costs. They're going to compare everything on a $5,000 project. But hundreds and hundreds of thousands of dollar commitment for a 30-year loan, people don't want to talk to more than one because the home buyer doesn't realize that it is normal to shop lenders. Like when you get your hard credit inquiry from the lender, you get a 30-day window to have other lenders of the same type hit it without taking another hit to your credit score because it's encouraging you to lender shop. Hopefully you can talk him into doing that. Marlon K. Howdy. Long time, first time. Nice. I got into my first rental in April and loved the experience. I've noticed lots of prices drop in my area, Columbus, Ohio, thinking about using a home equity line of credit to pick up number 2 or wait. Got my first rental in April and loved the experience. Okay, I noticed lots of price drops in my area. So there are 2 methods of investing. I mean, there are thousands, but these are the 2 that I talk about the most. Recycling cash flow and recycling capital. If your goal is to have a massive sized portfolio like Matt the Lumberjack Landlord or Michael Zuber, cash out refinances, sales to 1031, home equity lines of credits, makes sense because you add units. You greatly reduce the cash flow on the existing asset by increasing the debt and payments on it. So that the new one not only needs to make the return on the loan that's on that property, but it needs to justify the loan on the existing property. There's a couple of differences for home equity line of credit, but for me, that would be something I would think of as short term. If I can pay this off in 10 years or less, I might use the home equity line of credit. It has a couple of benefits. One, as you pay down the amount, that amount is reusable in case something else pops up. It doesn't impact the first mortgage. The drawbacks are the bank can close it at any time. They can go, yep, so you've borrowed 20,000. We're going to say you can't borrow the other 80. So we've closed a loan. You don't have to pay the 20,000 immediately, but you no longer have the 80. And what that does is it turns your 20% loan to value that you've borrowed into a 100% credit utilization. The other negative is if you could borrow 100,000, that hits your debt to income ratio, 1%. So they're figuring $1,000 a month into your debt to income ratio because you could borrow that. The cash out refinance right now, refinancing your mortgage probably doesn't make sense because most of us have the lower interest rates that came out in the last 2 years. Either you purchased them or you refinanced. And so you got your first one in April. I think it's in April, right? So you might have gone in just before the rates really started to go up. So if you're going to pull money out with a refinance, I would use a second mortgage instead of refinancing out the first. So you leave the first loan alone and then your second one pulls it out. So that's the first thing I always talk about is first, do you have a place to deploy the funds where it's going to make sense, where the return's actually going to justify the debt on the new asset and the old asset? Second, you've done one rental. How confident are you that the next one will get the return you expect? Finding, screening, maintaining tenants, maintenance, upkeep, rules and regulations, the things that we usually have down by our third or fourth rental. A lot of times I would recommend not putting your primary house at risk or to borrowing against your retirement accounts until you have reasonable confidence in your ability to get the return you're expecting. So maybe you're ready. How much self-education have you done? Almost made it an hour. And as usual, the unofficial sponsor of our videos is Alien Vodka, who doesn't sponsor the video, they just make it possible. So have you thought about that? And I don't mean, I think in my area I would. I mean, have you found a deal where the return would be that good? I preferred the patient method of saving a down payment, adding house hacking, so maybe you can acquire the next one with a better interest rate and a lower down payment. And it's not forever. It's a move for 1 or 2 years. Just better loan options. And what is your ability to save? How much are you saving every month? You know, how long would it take you to get? It took me, I moved into an apartment and rented out my house. So I was saving for 2 years to get rental income on my tax return. So my debt to income wouldn't matter because I had a bad debt to income ratio because I found out about a bunch of debt in my divorce that I didn't know existed until the divorce. So after those 2 years, I purchased a duplex. It was another 2 years until the next duplex. The first 5 years feel like they're slow and they take forever, whether you're going to recycle capital or not. You might have the option to do that right now. And in the last 2 years, we have seen the most appreciation that I've ever seen. You have a couple of good options there. It's one of those things where I'm not in your situation, don't have all the details, but hopefully I've given you a few things to think about. William, howdy. Tom and Bev, thank you. Brock, howdy. Hey, Dion, I'm about to graduate college and already have a job lined up, civil engineer, and want to start investing in real estate. Will I have a problem with getting a loan due to work history? You have a couple of options. Talk to lenders because some will look at your college experience as the same as your work history. They have different equations. I know that some lenders will look at half. So if you've been in for 4 years, you have 2 years work history. If you've been in school for 2 years, you have 1 word. So it depends on the lender. What you might struggle with is debt to income ratio, because they'll say you have consistent work history for those 2 years since you were in the engineering field training and you're now working in that field. But things like your overtime or your salary aren't really set. So they might qualify you for a low amount. One way around that is to look for a duplex, triplex, or fourplex and find a lender that will count the rent of the properties you are purchasing in your debt to income ratio. That eliminates the problem of your income being the barrier. You also have the option, the best option in all situations, whether you're a student, you're working, you've been working in the same field for 10 years, you change jobs every 2 months, is to look at seller financing. This is a time when you just don't matter. Will the seller agree to the price and the conditions of the loan? The other one is you can look at a DSCR loan, debt service coverage ratio. So they're going to look at the property. They will look at your credit score, but not your work history or work consistency. They're going to look at your credit score and then what does the property produce? So again, this is a time where duplex, triplex, or fourplex really stands out better. Some lenders in a position where you're coming out of college, while they might look at the college as you worked in the same field, they just increase the reserves that they require. So my lenders have said in the beginning, we want you to have 3 months worth of all of your principal, interest, taxes, and insurance sitting in an account for 3 months of all your loans. So even the one you're adding, so you have to have those reserves. I've seen people that were coming out that were changing careers or a shift, and the lenders would say, double that. You want 6 months reserves. So it's one of those things you might have to actually lender shop and loan product type shop. They call it asset based or DSCR. For me though, seller financing is the one to start with to see if it's possible. Hardest part with that is finding the seller who, first, their agent doesn't think it's illegal, and second, has enough equity for that to be the best option. And then Chester Williams put in a $2 super chat. Thank you, Chester, for an audiobook for the road. Gotta finish work. Okay, so far there are 2 super chats that qualify for the dice roll. I'm going to do it even if it's in a money loss. Don May, have you made any progress on your possible entry into short-term rentals? No. This is one of those times where it's funny. I haven't done short-term rental because I have mostly small multifamily. I always talk about having one single family house and the rest are all small multifamily, but in reality, like in true definition, I have 2 single family houses. I have one that was my primary before I was an investor, and then I purchased a triplex, which is actually a single family house and a duplex on one property, so it's a triplex. I don't want to do short-term rental on one unit of a small multifamily unless they all got empty at the same time. So I might have to do that someday. I don't know that I would, because I wouldn't want a long-term tenant next to a revolving door. It might just be in my head. So I was looking at the single family house and the house of the triplex. If they ever became vacant, I was going to try short-term rental. The house that I lived in is now rented to a Section 8 tenant that's probably not going anywhere. And the single family house asked me for a 28% rent increase. So I acquiesced. Instead of trying short-term rental, where I would make more money and try something new and be able to make more content, I just got a big rent increase. So that doesn't suck. I am making a video soon with Beth Traverso. She has a vacation rental, which I actually just stayed in for a week. That's where I rented the Sea-Doo for the video last week. I want her on the channel. I'm going to try to talk her into coming to the slides so that we can talk about the benefits of vacation rental, the good, the pros, the cons, the reasons why it might not be for everybody, and see how much of her numbers she might be willing to share. So I'm looking forward to doing that too. I do have a friend that all they do is short-term rental, and they keep browbeating me into trying it. And when they show me their numbers, it's very attractive. But the lazy. Matt Bittner, do you have mortgages on all of your properties? How many do you own? How many multifamily and single family? Great. Okay, so here's a good breakdown. Thank you for that, Matt. I have 7 properties, 16 rental units. So one is a single family house. The rest are duplexes, triplexes, or fourplexes. As you heard just a minute ago, the triplex is actually a house and a duplex on one property. One of them is an ADU. Don't know which is which. Don't care. One property, the single family house that I had before becoming an investor, I focused and paid off. There was actually a reason. It was my highest interest rate. It was like 6%. This was before 2018 when interest rates were hitting 6%. And it was my smallest loan. The others are duplexes or triplexes or fourplexes. So they were larger amounts. The house, I only owed $121,000 on it at that time. And then between 2013 and 16, you were allowed to have 4 mortgages in your name, and then you had to go to commercial or DSCR loans. And so I thought, well, the banks think 4 is safe, so I'm going to stay at 4. So once I got to 4, I paid off the house. So I had 3 mortgages. Since then, they changed it to where you can have 4 in your name to where you can have 10 in your name. So I started working towards getting 10 in my name. I got up to 6 mortgages. So 7 properties with 1 paid off, 1 single family, the rest are small multifamily type houses. I am about a little less than 45% leveraged. I think I owe 1.8 million on a 5.2 net gross value on the properties. So I would be more aggressive with that if I was still trying to grow the portfolio to reach financial freedom. But since I retired, coming up on 2 months in a few days, I think literally 5 days, will be the 2-month. That's July 5th, August 5th, September 5th will be the 2-month. Sorry, super shallow moment there. It's the ex's birthday, my 2-month anniversary of not having to work anymore. So that's what my loan structure looks like, Matt. Ryan, here's a hypothetical to talk about. If I took out $60K HELOC to buy an investment property that generates $20,000 a year cash flow with a 50-40-10, that is a whole bunch of math Matt, the lumberjack landlord, would just break that down in a second and tell you what the return is. So the $60,000 HELOC is increasing your payment on the house that you live in. So we have to factor that into the payment on the property that's generating $20,000 a year in cash flow. And as Matt is joining us, I'll read this question to him because it's math and confusing. Howdy, Matt. Welcome to
What's up, buddy?
the hangout. Appreciate you jumping in like this.
Of course.
Kids must be in bed now.
The kids are all in bed. School starts tomorrow for my 4-year-old. So
Oh, nice.
it's very exciting.
That's the kid that went a total of 2 days last year.
He did.
Is going to be a bit shocked this year with the length and duration of school.
He was pissed when he got stopped at 2. He's like, I want to go back there. I was like, I don't know what to tell you. Life's unfair.
Life is unfair. There you go.
Way it goes.
So I'm doing a thing tonight where anybody who puts in $1 super chat gets in their hat and their name in a hat, and I'm going to give away an Audible book.
Cool.
We'll be using the Dice of Doom, which I'm going to go get here as soon as I give you this question.
Okay.
So Ryan Allen sends a hypothetical.
Okay.
Here's a hypothetical to talk about. If I took out a $60,000 home equity line of credit to buy an investment property that generates $20,000 a year,
Okay.
cash flow. So that's not cash on cash return. That's cash flow. With a 50-40-10.
Okay.
What do you think that would look
So for me, I think I boil it down to something really super simple, which is it's all about my return on capital, regardless of the structure of the deal, regardless of how I'm trying to buy something. It always comes down to I'm a very simple man. And while I can do math in my head, it really comes down to only one equation, which is what is the return on the capital that I'm putting into the deal, regardless of where the capital comes from. The issue is you have a higher barrier to get over because if it's my capital, if it's my 60K cash, there's no cost to that cash. That's just what follows the buck method, which is best use of capital. When you're taking that 60 out on a HELOC, guess what? Now that cash has a price. So now you not only have to figure what your return is on the 60, now you have to make sure that your return is greater than that of your payment, plus the fact that you've got 60 grand into the deal. So that's why I think in a lot of cases, those deals may or may not work. Listen, you can get over leveraged, you can do that stuff. The issue is that if that thing is fixed for a year or 2 or 3 because it's a HELOC, that can be scary because I have no idea where rates are going to be in 3 years. But if I had to bet right now where rates are going to be in 3 years, I'm betting they're higher.
So that's my thing is if you're gambling on appreciation, most investors would say, don't do that. If you're gambling on where you think rates are going to be, I would say don't do that.
Yeah, I wouldn't do that. Yeah. I mean, and I heard you answer earlier on, someone asked about my variable debt. So a percentage of my portfolio has variable debt to it. It does.
A small percentage to where it makes sense for you to take that risk.
Correct.
And then
because still the return on that deal, the return on those deals is in the 30s. It's 32, 34, 36. They are massive returning equity deals or return on cash. So, and it's not like the difference was when I looked at the 30-year debt with Velocity, that was at the point where Velocity was almost, well, they were 7.75 on a DSCR on that type of a property. And I got 4.75 or 5. It was massive. It was 275, 300 basis points. It was a massive spread. And so I just said, yeah, I'll take oh, here he comes. All he had to do is figure out what dates mean. I felt like it was a Tommy Boy moment. Yeah, you see those letters next to the city? That's a state.
Sorry, fellas. You know what I've been doing all day? I had to swap out a water heater in the rental that I self-manage, which I've never done before. And yes, I did take your advice. I watched a couple YouTube videos. I also took the advice of paying my brother, who's an Army engineer, to come down from an hour drive to come help me out with it. And then we switched to light fixtures. So anyways, I was doing landlord stuff. I was self-managing. You thought you'd be proud of me.
I saw your video on Facebook. Saw you tapping your water heater. What part was leaking?
You know, that's a great question. I'm not actually sure. So it's sitting on a little platform table, and it was just all around the base of it. There was water, and it was dripping decently, especially as they would turn the hot water on, then it would run more.
Yeah. So if it's from the base, you usually want to replace the water heater. I've had like 5 in the last 10 years where it's just the line at the top. So if you get leakage from the top, I replace a $12 line.
Correct.
For another couple of years.
Yeah. Leakage, even me with my limited amount. Go ahead.
Yeah, leakage from the bottom is the pan. So when you look at a 5-year classes in session, when you look at a 5-year, an 8-year, a 10-year, a 12-year warranty water heater, do you know what the main difference is? The thickness of the pan on the bottom.
Interesting. What causes it to wear out?
Usually condensation. It's usually condensation, and the fact that think about what a water heater is doing: heating up, cooling down, heating up, cooling down, heating up, cooling down. And so what ends up happening is, the lesser material and product that's used in those cheaper ones, like they have ones, we call them basement pool specials because they'll create a pool in your basement for free.
Yeah.
And those are like the 5 years, because you'll be like, literally you can time it 5 years plus 1 to 6 months. That thing's going to leak. It's almost guaranteed. It's almost guaranteed. So yeah, it's usually the issue. The other big issue too is that here in the East Coast, in Siberia, they'll usually put that unit in the basement. And so it's going up and down in temp. I mean, you can have a swing in your basement of 60 degrees from winter to summer if it's not a finished or what's called a conditioned space.
Okay.
I have a handyman that is going through all of my units in the next 30 days and looking at every water heater that's over 8 years, and we're just swapping them. No issues. Just
great idea.
Time to do
Great idea.
What's he charge you for that? Out of curiosity.
I think he's $200 for the swap out. I have them delivered, so he doesn't have to bring them there or anything. And I'm finding them around $800 to $900 for the thing. So all total, it's probably $1,100 to $1,200 when I'm done.
So, but he's only charging you $200 to swap it in and out.
Yeah.
Shoot, man, I'll pay that price next time. Heck yeah, that's not bad. I'll just go buy it myself.
I'll connect you with him. He works all over Pierce County.
Yeah, 100%. I will take that.
Before anyone else goes to do that, I must give a disclaimer. You need to check your state and local statutes, because that is technically a plumbing fixture. And because it is a plumbing fixture, if that thing blows and leaks everywhere, they're going to ask who fixed it, and they can use that as plausible as a reason to deny any claim.
So here's the 2 things that you're right about. 1, if you have a water heater in the house,
yes,
do it. I've got some that are in mudrooms that are cement. That's where I have the handyman do it. I have most are in garages on cement. There's not, it could blow and do anything. It isn't going to hurt anything.
Sure.
But you're right. If it's inside, same thing with electrical. You have to have your licensed contractor do certain things. It also pays, the handyman that I'm sending you has like 3 different licenses. The only thing he doesn't have is roofer's insurance to go up above 8 feet on anything.
Does he have a plumbing license too?
Yeah, plumbing, electrical. And what he is he's got subs. He's my handyman who has subs. Because he used to run a contracting business. He might not be GC. That's why I said I don't use them for anything above 8 feet.
Got it.
The other stuff I do. And then let me really quick get to these super chats, because Mike wasn't here when I was talking about it. What I'm doing tonight is any super chat that is at least 99 cents. I'm going to use the Dice of Doom, and give away an Audible book to your email. So whoever wins will have to share their email with me, and I'll do that at the wrap up at the end of the video. So if you have to leave earlier in the video, just skip forward to the end. And then in the last like 5 minutes, I will figure out who that's going to be. It doesn't have to be a finance audiobook. I would like it to be one rental at a time, Rich Dad Poor Dad, Set for Life, something that will help you on this kind of a journey. 15 Conversations with Real Estate Millionaires isn't out yet, but it's in the last stage of approval. So it's all uploaded to Audible. It would be great if that's the one you chose. So that's why people like Chester sent $2. Chris Ledbetter, Dion for president, since you are retired now. I didn't read retired the first time I looked at it. I thought it was a great answer. No, I couldn't take the pay cut. Legacy OPP, AC/DC rocks. Nice.
It's my boy right there.
Nice. I did a live stream earlier with a guy that retired in 4 years today, named Dan, a friend of mine that I kind of make fun of in a lot of the videos. He worked at the truck driving school with me, 2018, started investing, retired August 19th. No one's counting, but like 42 days after me. And he was talking about Harleys.
Yeah.
And somebody did a super chat because Harleys are awesome.
Harleys are awesome.
Indians
are better.
Indians are better. So I had a Honda NT 700. I gave it to my brother, but that was my motorcycle, was the Honda. He would every now and then run an extension cord out to it to charge it for me at the end of the day, to pretend like it was an electric bike. So every now and then I would dip my fingers in the oil at our truck driving school and I would splatter the ground underneath his bike so that he, for years, kept thinking, I don't understand where this leak is coming from. They've checked everything.
That's mean.
And then a super chat from Millennial Mike. Like the video if you are real estate gangsters. Ignore if you want to work until you're 70.
Dude, it's pretty easy to just like the video, fellas. I'm going to do it right now on the live stream. Ready? Watch. So you're looking at the video. There's this little thumb, right? It says 29. Boom, 30. It was really that easy. Like math
The
in
thing
high
that gets a
school.
lot of people on the mobile devices is you have to close the chat down to hit the thumb to open the chat back up.
Yeah.
Let me see where I was at with the questions here.
Oh, dang, Dion, you're at 11.1 thousand subscribers. So you picked up 100.
100.
Ain't
Yep.
teetering around it anymore.
It was funny. It played with that 11,000 for like 3 days. It would go 2 over, 3 under, 1 over, 1 under.
Stop
That's
making
Matt
such
trying to get
offensive
it.
content.
Yeah. Exactly. I think what it is a lot of times we talk about channels and we say, look, this channel's been calling for a crash, nothing but a crash. So they're getting a lot of views and they think we don't like the channel. We're watching that channel. They make good content. They have great videos. We disagree on something.
Sure.
Big whoop.
Yeah,
Like we don't agree on things.
it's true.
Like, yeah. And then, so right after my last comment about the taking out a home equity line of credit, legacy OPP needs some clarity on a home equity line of credit. If you have $100,000 open available, shouldn't that increase your credit score? No. And put you in a better position for, say, an auto loan. So it does mean you have low credit utilization on that one line of credit, but it means you have available credit, which could negatively impact your credit score because you could borrow that money.
Correct.
So there's an equilibrium there that you want to look for.
That's right. And what's very interesting is I worked with all the different credit bureaus, TransUnion, Experian, and Equifax. It is very frustrating because they all have multiple algorithms. They don't just have one way to figure credit scores. They have dozens, depending on the industry that's looking for the score. They create a score for that industry based on the default factors of that, essentially ideal customer profile. So yeah, that's from my last life. I'd rather not talk about it.
Yeah, there's a couple of different ways that they talk about credit scores. And the one thing that this channel is a how to fix your credit score, because I only have like a 790. If I had like an 830 and I knew how to get it there really super quick in 6 months, I'd make videos on that. So I would actually go to some of Graham Stephan's earlier videos, like 3.5 years ago. He had some really good credit fixing videos on there.
I did just pull out a HELOC on my primary residence so that I could use the cash to purchase other rentals and remodel them. Pulling out the $125,000 HELOC line of credit did nothing to my credit score. Didn't affect it negatively, didn't affect it positively. But the second that I actually transferred money from the HELOC into an account and now took additional money out, my credit dropped precipitously, just like it would if you had a credit card and you were over your 30% maximum credit limit or like 10% utilization. And I mean, as soon as I pay it off, it'll come right back. So I'm not worried about it. I'm not stressed. And I still have an over 760 credit score, but you can expect that to happen if you're using a HELOC.
So here's an impact that Matt, the lumberjack landlord, had with a line of credit. The line of credit was $75,000. He spent $25,000, took it, and so he owed $25,000 on that line of credit. 33% credit utilization. When they closed the line of credit and you could no longer access the excess funds that were there, you didn't have to pay back the $25,000 all at once, but you are now at 100% credit utilization.
Yep.
So it's something to be aware of.
Yep.
Amafid, Howdy, love this channel. Matt's isn't bad either. That's like the
Thanks.
second best compliment I've heard.
Matt, yours
No.
isn't even that bad.
I find you tolerable. This is love.
Oh, that was what was the comment? Troy Good gave me the best compliment I think I ever had. He says, I think you're funny, but not annoying. And I was like, that's what I'm hoping for right there. Can't get better than
Mission accomplished.
that. Right.
I tell you, Dion, I feel like I should be paying you with all this stuff you're setting me up on Facebook.
Exactly.
I'm going to take my show on the road at this point.
I do give you some ammunition.
It's so easy.
Yeah.
But that's all right. I just had a chance to glance at it when I was up on my lunch break from my job that I was working today.
I had a lunch break today. Me and Dan, when he came over, I told him, look, come over, do the video. I'll take you to lunch. Because he was super nervous, super,
You
I
did
don't know
great.
about doing a video. And I'm like, you're great. You got a great story. Literally,
Yeah.
people said very inspirational, which is exactly what he needed to hear. So the Cliff Notes version, he was 58, had been running a construction company that went belly up in the 2008 crash,
Oh.
started working at the truck driving school. Like I kind of walked him through the steps, got him a CDL, was going to help him find a job. We needed a fleet manager. So we hired him to like run our fleet. So not be an instructor, but like get the trucks everywhere they're supposed to go, take care of the fleet. Worked
Okay.
there for 10 years. He was making $42,000 a year. So he wasn't like in a really high paying job, had no retirement set up. But in 2018, he started buying small multifamily by having his son move in, son and daughter-in-law, doing a house hacking version, rinse, repeat, got to like 9 units. And some of them have like 9 properties. Some of them have like 5 units because it's a house, a duplex,
Oh.
3 RV slots, to where he retired.
That's
August
so
19th.
awesome.
Like 4 years to get to the point where his cash flow is twice what he needs to retire. And he's 62 now. So he doesn't have to wait until he's 65, 7, or 70. It was great. Jay Hayes asks where I got the sponsor for today's video, which is the pirate mug, because your vodka Mountain Dew, water, tastes better when it's kept cold, because you put this mug in the freezer and the inside metal is very cold to the touch and keeps your drink cold, like the Bullet sponsor. So I put a link in the comments of today's sponsor of the video.
I had to reorder my bullets.
Because they messed up your order.
Yeah. I was quite disappointed when I was drinking my watered down water today. Watered down warm water.
Oh, no good.
Gross.
Then I'll go through these again as I hit them. Thanks, Chris, for the super chat. I've got your name in the list. Thanks, Legacy. And Ryan Allen, thank you. I appreciate that. We're doing a couple things here. One, somebody's going to get an audiobook. I'll talk about it at the end of the video, who's going to get that. And second, you're actually showing the YouTube algorithm that somebody likes this content. And Mike, thank you for that. And Legacy, OPP is short for opportunity. Thank you. Oh, Legacy Op. Okay. For some reason I had, how can I explain it in my head every time I said it? Another way to call a cat. Jason C, I hit the like button. I'm set for life now. Perfect. It's exactly how it works.
Dion was thinking, you down with OPP? Yeah, you know
Right.
me.
Yeah, you know me.
Okay. I knew Matt would get that. I was wondering if Mike, you're wearing an AC/DC shirt. So your music comes from that generation.
Exactly.
So, thank you, Ryan. And then Kurt. Howdy, Kurt. Have any of the three of y'all done a 50-40-10, a little insight of the process with the seller agent? Matt, Mike?
Mike,
Have you guys done it?
yeah, Mike. I've gone down the path a couple times. It didn't materialize. They basically just didn't want to take the 40% note. They just said, nah, I really just want to cash out and pay my taxes and overpay. Because I literally said that to them. I said, so let me get this right. You just want to make sure that you're paying a ton of taxes and don't really want the tax benefit? Yes.
Human
So
beings
the
are afraid of change and they're lazy.
Well, in all honesty, I think that there's a lot of, largely that needs to be a more than sophisticated investor, right? And anybody tell you that they have a higher hit ratio than 1 in 20 on that idea, it's lying. Because it's a very specific thing. And in many cases, if it's a smart person, the first question that they ask is, So why am I gonna be in second position on a loan and I'm gonna be the credit? I'm gonna be lending you, basically giving you credit based on that I'm not a bank and I should figure that out. It's a challenge. And so I think that it's like one of those things out there where the Pace Morbies of the world and all these other different players out there, they're amazing at what they do. And there's no doubt in my mind that they close a lot of those deals. But they are in a target rich environment where I could catch a fish if I were talking to 30 of those people a day or 20 of those people a day too.
Mm-hmm.
So there's two things you're looking for with the 50-40-10. The first is the lender that'll play game. Like you need to find somebody like Velocity Mortgage that actually has that product. Some lenders don't do it. And second, you need to find somebody who's in the right position. So they need to have enough equity for them to carry the 40% note. So they have to usually have owned the property for a while, have not refinanced, pulled money out. So you're looking for the lender who will do it, the person in the position who will do it, and then your ability to talk them into it. Because in most cases, you're educating them on the benefits to them. And so I agree with Matt 100%. I think...
Hey, don't feel like you're a failure if you can't get one. Like it's because I think that there's a lot of that expectation out there, right? Like, what are you doing? It's creative financing. You should be able to do it with anybody. No, if they were that good at it, they wouldn't be selling a program at it. Like, I'm sure that they're good at doing it, and I'm sure that they have higher hit rates than others. But this is not a one size fits all deal solution. It just isn't. It's another arrow in the quiver that gives you another bite at the apple when you're trying to put a deal together. That's what it really is. But that's just me. I'll let you know Friday how it goes. I'm pitching one at 10 a.m. on Friday morning.
Nice. Let us know how it goes. Jason C jumps in with the right sense of humor. Yo ho ho and a bottle of rum. Thank you for that. Appreciate it. Matches today's sponsor. REI Stoners. Howdy. And howdy, Jason. So hi guys. Do you know if having credit cards with no balance is helping in any way when it comes to investing? I have 3 with 70,000 available. I don't use them anymore, but keep them in case of emergency. So there's a couple of ways they can benefit you. One is how long has the account existed? As long as you're not going above 10% credit utilization on them, they do count in your favor. But some credit cards will cancel if you never use them. They actually just close down the account. And if you call and cancel them, that could eliminate the track record of having an account open for a certain amount of time. So it's not that they benefit you, it's that if you go above 10% utilization, it can hit you as much as 30 points on your credit score. So you want to try to avoid doing that. You could have some lenders, when you go to lend, look at your available credit, and whatever your score is, they could say, I don't like you because you have too much available. We could lend this product, and then you can max those cards out. Sure. You have that option. So it's kind of a balance of you want enough. I have increased my credit score by doing this. I had a $5,000 credit limit, and I was doing $1,000 to $2,000 a month on that card. That's the card that I use every month and pay off every day. So it was a high credit utilization. I called the bank. They increased it to 17,000, and I'm still doing $1,000 to $2,000 a month. So that improved my score because I'm no longer doing the 10% or more credit utilization. But if I kept on doing that and kept increasing and increasing and have more available credit, that could be a negative for you too.
Yeah. So you also want to make sure too that card's being used. So I wouldn't, for me, if it were me, and what I've done with my cards like that is I'll just put a charge on there, whatever it is, $1,000, $2,000 from something that needs to get done. Pay the $1,000, $2,000, $3,000, $4,000 on that card and pay it off. But then it shows at the end of the year that I spent $4,000, $5,000, $7,000, $8,000, $10,000 on a card that might have a $17,000 limit. It shows I spent 10 grand on the card that year. The bank's not going to shut it down. They're likely not going to reduce your credit line. And for you got, I would just make sure that you have ones, again, that length of time that you have a credit card. I haven't used my Discover card with any level of regularity for probably 15 years, but I've had it for 27.
Okay.
Can't get rid of that card. If I get rid of that card, I shut down a 27-year line of credit. It's not good. Yeah. It was a secured Discover card when it started. It was like $1,000. I had to pay them and then use it for a year.
I was just sitting here thinking how you've been an adult for more than 27 years, bro.
Oh yeah, dude, I'm old, man. I'm old.
Love you, buddy.
Listen,
Ryan
not all of us have a metabolism, Mike, so shut up.
Ryan Allen says that is currently his issue, is trying to get the seller and their agent to get on board with the 50-40-10, trying to convince them of the benefits. One of the things you want to do, Ryan, is make sure you remind that agent that your down payment is going to include enough money to cover their fees. That's why a lot of agents are resistant to seller financing. They think you're trying to bypass them or cut them out because they just haven't thought it through. Your down payment has to, because seller profit, that money that goes to the seller is usually where agent fees come from. So they're thinking, if you're seller financing this, the seller's not getting a bunch of money. So you have to say, my down payment includes what it's going to cost to get you paid.
Yep.
Kurt Jones, howdy. Just not the right seller for that closing process or strategy. Yep, exactly.
Yep. 100%. 100%. There are people that will take that 100% loan too. But those guys are few and far between.
Yeah.
Like they just are, like the 0 down 100% loan, fully leveraged. I would check. They probably have a pretty good lawyer and they're probably going to find a way to take it back too.
Mark, howdy. What is your thoughts on equity stripping? I hear of some people that just take out home equity lines of credits on their paid off or low mortgage primary to make it look as if there is debt on the property. Some people do that to put a bank in first position as a form of asset protection. Some people do that because they want to buy the RV or the boat. And unless you're going to Turo those things, I don't think that's a good call. Some people make this huge mistake and they let the tax tail wag the dog. And they say, I don't want to have a paid off property because I might have to pay some taxes. So instead of paying $1,000 a year in taxes, I'm going to pay $10,000 a year in interest so that I don't have a $1,000 a year tax problem. If you have a mortgage, you benefit from the tax benefits. If you have a paid off property, I would not take out a mortgage for the tax benefits. If you have a place to deploy those funds that's going to get you a good enough return to justify the debt on the asset and the new asset, sure. That's what Matt and Mike have done. They have recycled capital, done lines of credit, cash out refinances to buy more properties because the goal is more units. Not my strategy, but it's one that's actually worked better than my strategy for the goal that you and Zuber were going for.
It's true. It's worked out well.
Jason C. RAI Stoners, if you haven't used them in a while, you make a small purchase and then pay it off to show you still using it every now and then, just like Matt said. Good, exactly. And Matt saying it. Yep. Don and Bev Perkins. Yes, we just got a letter for one that I hadn't used in 4 years that they were going to close down unless we used it. So we charged something. There you go.
Yep. Now recognize that right now that letter is, we're going to close if you don't use it. When the economy goes into a heavier recession, it's not an if. They'll just send you a letter saying we're canceling it. So I encourage you to do your own homework. I actually run a credit report. You can get a free credit report for yourself every single year. You can look up and you can see what credit cards are open. And for some reason, if the card that you have, I literally had ones that I hadn't used in a long enough time where the card had expired. So I actually had to call, get a new copy of the card. Then I got a new copy of the card and then I used it. So yes.
Okay, we're going to give a couple more minutes here to wrap up. So if there's any questions that you want to sneak in before we shut this down, let me know. So far, we have 7 super chats for the audiobook. And as big of a nerd as I am, I have dice for 4, 6, 8, 10, 12, 20, 30, 60, and 100. So I think 8 is as close as I can come. This is who wins the audiobook. So good luck. And it'll be in the order that they came in.
I'm very excited to have my new dice coming.
7. So that would be
Is that
Jason C.
Oh, okay, good.
Pirate. So Jason, this is my email. Reach out to me. Somehow convince me that you are who you are so that I can send you the audiobook. And it doesn't have to be finance related. That's just what I would like. It looks like we'll give it just a few minutes to see if any other questions come in. Sponsor of next week's video. Ooh, mask is steel. Edged on both sides. I call this my size 10 Mark 1 people opener.
Yeah.
Be real tough to track down that murder weapon.
Right, exactly. It's got its own fingerprints.
Yes. Yes. That thing's crazy.
We got to tell people about what we're gonna live stream on Thursday with Zuber. It's gonna be the 4 of us, and we're gonna talk about quiet quitting. If you haven't heard about it yet, or even read an article about it yet, Business Insider's popping off articles left and right. It's popular on TikTok, Instagram, Reels. But what quiet quitting is it's this new sensation that's sweeping the nation, where people are saying, well, I'm being overworked. I'm burnt out of my corporate lifestyle, my corporate job. I'm going to stop accepting additional work. I'm going to stop coming in early, staying late. I'm not going to put forth the extra effort. I'm just going to do the bare minimum. So we'll have some videos we're going to watch to react to. I might even pull some excerpts from articles. We're going to listen to what the 3 amigos have to say, their thoughts, their take on what quiet quitting is. It's going to be 10 a.m. Thursday. I don't think we picked a channel who to live stream yet, but probably one of you guys are Zuber.
Be on Zubers.
Oh yeah. All right, good.
Yep.
The big Zoob.
We're trying to get him to 50,000 because once we get to 50,000, we're having the live in-person meetup in Vegas.
Mine's really short and sweet. I only have a 2-word answer to quiet quitting.
F you.
No, it's loud firing.
Okay. Loud. Yes. I like it.
I, as an employer for the last 13 years, would disagree.
I know you would. Of course,
I will have a
you
great
would.
reason. I'll have my actual
Don't
justifiable
spoil
reason
it.
Of course you
on
do.
Thursday.
Of
Show up at
course
10
you do.
a.m. on one rental at a time.
Good.
And we do have a couple of more questions coming in here. I said we'd give minutes for to
And
wrap
that was
up.
just a joke, Dion.
Oh, boy. I know you're still worried about HR suing you because you fired somebody for quiet quitting, but the best. So, no, I don't want to.
I won't say. I'm not saying anymore. Yeah,
I
I'm not
want
saying
because I want
anymore.
Thursday
Yes.
to people to
Yeah.
show up and find out what the heck. Why is it a good thing sometimes?
Mhm.
So Jason, thank you. You hopefully you enjoy the audiobook that you get. Joshua Joseph, howdy. How do I make a single family house hack a rental income for tax purposes? Do I need to get a CPA? So as soon as I had a rental, my suggestion is to get a CPA or tax pro. Matt, you know the terms of the person. What's the other, not CPA,
EA.
but
EA.
an EA?
Enrolled agent. EA.
An EA, okay. Not EA that Microsoft or whatever it was, Amazon that
EA
just
Not EA Sports.
EA
no.
Sports, right? Okay.
Just EA. Yep.
Right, because there are multiple forms of depreciation. It's not just the amortized depreciation of the 27 and a half years of the structure. It's some things are scheduled over 7 years, some things are bonus, some things are the amortized. Those are terms I don't want to know. I know that they exist, so I hire a pro that knows what they mean. I give them a spreadsheet with the notes that tells them which my expenses are. And if you're doing a house hack on your house, they'll be able to depreciate the portions that you're turning into income generating. The tax pro will be the one that you get that information from. I absolutely think you need to hire that tax pro. Those are records that are going to impact you the entire length of that property.
Yes.
When you are living in a different one and that whole place is rented out 5 years from now, how you file the taxes this year is going to impact that 5 year from now tax record.
Yep.
So
Yeah, great advice.
Million. Howdy, amigos. Howdy. Tony, howdy. Friends, what wood blinds do you recommend from Lowe's, I believe? That would be a you guys question.
The faux woods are fine. I usually go the next step up. But the faux woods are fine. What I find about the faux woods is that they, if you don't catch it right, it can drop and you almost always will snap one and then the thing's done. So I use the honeycomb. You can get the honeycomb light reduction blinds. They're a little bit more expensive.
So the reason I wanted you to answer that is I wouldn't know what kind of blinds I got. Here's what mattered to me. Find the 3 or 4 Lowe's that are within driving distance of your house
Sure.
and figure out the least challenged person who works in the blind section. You will have one at one of those stores, and every store will know who it is. Find out their schedule and buy your blinds when they're at work, because those machines are finicky. And I've had 5 or 6 problems where you go in and they just can't get it done right. And then there's this one in Thurston County, Washington, where there's a Lowe's and you go in and this one person is there who's like a savant, and they come out right every time. Yep.
100%. You're exactly right.
I still don't know what kind of blinds I buy. I just know that when she's there, that's who I go and work with.
You probably buy the faux wood 1 3/4 plank blind is the one you probably buy.
Probably, yeah.
I'm just guessing.
Ryan Allen. Damn, I wanted to get the audiobook you made of 15 Conversations with Millionaires. So when that actually comes out, I'm probably going to do a live stream and give away several of them. Not out yet, but like I said, it's uploaded now and ready to be finally screened. Mark. Just to clarify, equity stripping as a form of asset protection, right? Like I said, a few people will put a loan on a product to put the bank in first position. I would do it if you also looked at it as, here's how I'm going to deploy those funds to generate a return. So the added benefit is asset protection. That's one of the 3 forms of asset protection that I do use. Million. How do you wait? Could be AT.
Patiently.
That's something. What's that?
Patiently.
Patiently. I think there's something that we're missing there. Amafid, you guys should have that ADU guy on your respective shows. I have talked to him 3 or 4 times, and every time we talk, we're like, hey, let's do a video. And then it doesn't happen. Mostly because I think he's super busy doing ADU builds, which I totally get. I do know that when I watch his videos, he gives out his own personal phone number and answers every text that goes to him. So I definitely want him on the channel. He's been on Zuber's channel and he shares great information. So I would like to have him on here too.
He did a deep dive. He was fantastic. Yeah.
Joshua Joseph. And how do I need set up my finances, bank accounts, transactions to make it easier to show as a rental income in the future when applying for future mortgages? Basically, the only thing they're going to care about is 2 things. Is it claimed on your tax returns? And do you use actual signed leases and keep copies of them? You need to be able to show the track record of, here are the leases and it's on my tax returns. Even if you're showing a loss, remember, when you take in rental income, you'll have profit. Hopefully that's the goal of renting, even if it's just lowering or reducing your housing cost with this house hack. That is rental income. You will now get to use depreciation against it. So you're probably going to show a loss. So you won't pay taxes on this income. And some people think, well, how am I ever going to borrow if I'm showing a loss? Like last year, I had $128,000 in rental profit past everything. And I carried forward an $8,900 loss. It looks like I lost almost $9,000 on my taxes. So how can I ever get another mortgage? Because I want to say it the right way, but I always get it wrong. Because I want to say lenders aren't stupid, but that's not true. Lenders take out depreciation when they're factoring in your income. So record it on your taxes, keep the leases.
Yes.
Anything to add to that? There you go.
I would look at, for me, I just love DocuSign and Dotloop. I don't care which one you use, but I use DocuSign for everything now. And so I don't even have physical leases anymore. I can take it, I can download it. It's an email. And that one, when the bank asks about a specific property, it's literally less than 3 seconds and they have all the leases in their inbox. Very easy to manage. It's a legal document. DocuSign and Dotloop are considered legal docs. So
what I've done is every time I sign a lease, I scan a copy to the tenant, but I email it to my email. So I could be in Thailand and I could be working on a deal, which I closed on one when I was in Thailand. And I emailed the leases to show these are the existing. They don't need wet signatures because it could be a fax or an email either way, whatever the bank requires. But it does need to have both signatures on the lease for it to be a real document. REI Stoner says, quiet quitting isn't new. In my day, it was called lazy. There have been several terms for quiet quitting since the 60s that I know of. I wasn't born in the 60s, but I know of the terms from then.
Yeah, the .com bubble, it was rest and vest, I think it was called. Yeah.
That was a real tech term, the rest and vest.
Correct. Because everybody was getting their assets vested or their stock options vested.
There you go.
Yeah.
Million, how do watermark rental property photos to advertise? What else do you do to avoid a potential tenant from getting scammed? So that I'm hoping that you saw my video earlier today with Dana Dunford, the CEO of Hemlane. So I go to Canva, canva.com. It's a free, they have a paid service if you want to use special pictures and special fonts, but just use the free one. You go into it and you put text over it with your email or your phone number or whatever you want for your contact info on the image. And then on Canva, there's a way to change the transparency of the text, and you just slide it down until it looks like a good watermark color, and you put it in several places because there's no real way to stop them because they can literally block out whatever you put the watermark on and put theirs over it, but it's more work. You're just trying to say, look, if there's those other people that don't put watermarks at all, they're the good person to use the scam on. Mine, I make you do extra steps, so you're probably not going to do it on mine. There's no way to stop people from getting scammed. Like some of the ridiculous type of scams that I've heard people fall for. My friend has an Airbnb, has a tenant at the Airbnb. The tenant at the Airbnb calls and says, there's a tenant here showing up to drill out the locks because they're saying that you're in Europe. They've rented the place, paid the deposit, and they're just supposed to swap out the locks. That person showing up to do that fell for that. Had the Airbnb tenant not been home, they would have went in, changed the locks, and the Airbnb would have, people will fall for scams all the time, but you can make it harder for the scammers to use your pictures. Joshua Joseph, thank you guys for your wisdom and motivation and jokes. It really helps a newbie like me feel more confident about investing and makes it more exciting. Awesome. That is why we're doing this. That cash flow, Johnny Ramirez, howdy. What's up, real estate freaks? You made it right as we're wrapping up the live stream. Jay Hayes, have a great week, guys. Cheers. Sundowner, anyone? Oh, on the sailboat? Sure. Let's get out on the pirate ship. Somebody was sending me, there's a pirate ship for sale on the East Coast. If I can figure out how to get it on the West Coast, I might be living in the thing.
I'll sail it there for you.
That's a long way to go, man. I mean, even if you go through the Panama Canal, that's a long way to go.
It is quite the trip.
I have time probably in the next 3 to 4 months. I'm going to have wide open schedule.
Oh, wait, are we starting to call a date for our boy here?
It's close. 45, 614. So that's still, still the number at the latest. So yeah, I've never been this close.
We'll see.
Never been this close.
Cool. Well, thank you both for coming on here, taking your time to help me educate people. This really does help. There's 4 words when it comes to investing that I think help everybody move to the next stage of what they're supposed to be doing. It's hard to do anything until we're confident. When you go to the shooting range, if you don't want to shoot with the other people on the range, unless you're going to be hitting the target, it takes going to the range and learning all the basic skills to get on target. In real estate, it's hard to do anything until you have that confidence. And confidence is the 4 words. Confidence comes from competence. When you learn how to run the area average rents, you're more confident in your ability to calculate your yield. When you learn how to advertise your rentals, each one of the little skills that we talk about that you put together to make you more confident is going to make it to where it just makes sense for you to call the lender. It just makes sense for you to set up your auto searches. So the more things that you learn from each video that you watch, the more subconsciously confident you're going to be in your abilities, and the more likely you are to actually take action, because that's what it takes to reach financial freedom. Nobody's going to come to your house and drop off a rental in your lap. That hasn't happened to me yet. How about you guys?
Yeah. I was going to say, put me on that list.
Right. Awesome. Thanks, everybody. Congratulations for the audiobook. I think I'll do that. I don't know about every week, but it depends on you guys. Let me know in the comments below if you want to see that more. I'm trying to get more people into audiobooks, especially don't have to be, but if it was finance related, that would be awesome. So remember, the 3 amigos of the REI Avengers are going to be on one rental at a time, Thursday morning, 10 a.m. to talk about quiet quitting. Until my next video, thanks for coming to my Dion Talk.